There's not a lot of overlap between Cathie Wood and her portfolio, along with Warren Buffett and the Berkshire Hathaway multi-hundred-billion-dollar portfolio, and yet there's one company that they do both own, and that is StoneCo, STNE, a Brazilian hypergrowth fintech company that strikes me as really interesting. You're looking at very strong growth, potentially unrivaled value proposition at a interesting valuation multiple, potentially if they execute in the years ahead, offering 100, 200% upside if they continue to execute like they've done in years past. We'll talk about all that in 1 minute, but what gets me really excited is seeing the fact that the stock is down about 55% in just the last few months. So this makes me wonder, am I potentially bargain hunting as I'm looking at StoneCo? In full disclosure, I don't own any of StoneCo stock. This is STNE is the ticker. As of the publication of this video, I'm still reviewing it. Unrivaled Investing Journey subscribers, they'll know if I pull the trigger. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. I'm looking for potential multi-baggers, folks, the types of companies that could potentially go up hundreds or even thousands of percent over time. So let's dive back into StoneCo to understand what do they do. And it's all about enabling Brazil's small and medium-sized businesses, giving them access to payment technologies. And Brazil is, and when you look at StoneCo, STNE, they are Brazil's largest independent merchant acquirer. So what's that mean? So merchant acquirers are licensed firms that contract with a merchant. So think of a small, medium-sized business. Maybe it's a restaurant, maybe it's a shop, to provide them with payment acceptance solutions and technology, facilitating the processing, clearing, and settlement of each electronic transaction. Think every time you want to use a payment credit card. There are lots of different types of merchant acquirers, primarily bank-owned acquirers or bank-controlled acquirers. So then you look at StoneCo, and here they are the largest independent merchant acquirer, the fourth largest in Brazil. And so when you think about StoneCo, it's more than just acquiring potential merchants to enable them to effectively, have payment processing solutions, but it's enabling merchants to sell offline, online, have mobile solutions. That's what omni-channel acquiring is, this point of sale solution, so that way you can easily take a credit card or a debit card. It's also enabling e-commerce with their Pagar.me, which has a whole host of different solutions for potential merchants, such as social commerce functions, checkout functions, analytics. And then you're also looking at additional e-commerce value where they talk about having recurring billing or one-click buy. So a lot of what you look at with StoneCo is sort of an umbrella that has many different offerings depending on where the merchant is, what they need. If it's an offline and they need a point of sale, they got that. If you want to have an online presence or you want an omni-channel presence, they can enable that as well. And not surprising to see, you're offering all these types of solutions, and they've delivered exceptional growth, growing from 163,000 merchants, effectively clients on their platform, to 766,000 from first quarter 18 to second quarter 21. They also have a solution that's targeted to smaller businesses that has gone really hyper growth, growing from 23,000 to 330,000 in just a few quarters. Really incredible what they're delivering here. And as I look at it from 2020 to 2016, keep in mind, this is all Brazilian real. You're looking at their revenue growth of 7.5 times from 2016 to 2020. That is incredible growth. You're looking at 7.5 times growth in the total processing volume, so the value that goes across their platform, from 28 billion to nearly 210 billion in 2020. And a company that's increasingly profitable over the last 3 years. So, wow. I mean, how many fintech companies in the US trade where they have these types of growth metrics and they're also profitable? So this definitely has my interest. Not surprising to see Warren Buffett's Berkshire Hathaway own a stake in this company. And clearly they're taking share. They talk about their market share of the Brazilian merchant acquirers business effectively going from 6% of the market to nearly 10% in the fourth quarter 2020. When I see a company steadily taking share year after year, growing way faster than the market, I think, okay, they're probably doing something special. They might be unrivaled. So what are the different data points that can make me think, that StoneCo sort of points out that could make me think they're unrivaled? And they spill out a lot of different things. They talk about, one, is we believe current models that sell payment acceptance solutions through traditional bank branches. This is, keep in mind, this is what I was talking about earlier about there's independent solutions and then there's bank owned merchant acquirers, and they talk about how the current models through traditional bank branches are outdated and provide a poor client experience for business owners. Bank sale representatives are not specialized in payment acceptance solutions, and as a result, they lack advanced knowledge of how new technologies can impact the merchant point of sale. In addition, the client onboarding and fulfillment processes through bank branches can take weeks to finalize. This contrasts with StoneCo, where it could be hours or days to get things done. So you're looking at better service. And then they also talk about how they have their team of green angels that provide local support personnel who can serve our client in person within minutes or hours instead of days or weeks. So this is a white glove as they talk about on-demand customer service. This is really special what they're talking about. And it's very clear that they really do value customer service significantly, with 94% of our clients who called our customer relationship team had their issues resolved on their first call. 91% were answered within 20 seconds. 86 were rated as excellent by our clients. This is exceptional customer service. I wish more partners that I use, more merchants, businesses that I interact with have this level of customer service. Not surprising to see that they have a net promoter score of 64, which is the highest among their peers in the key markets in Brazil. So these different data points suggest, okay, they're winning because of better service. They're winning because of better execution. This might just make them unrivaled. And when you see everything that they're doing, you go, wow, not only are you offering lots of different solutions, but you have this better customer service that's resulting in taking share. And not only are they a merchant acquirer, which is tapping into this 20 billion real market, you're looking at additional solutions, additional options for this business where they can grow significantly over time, such as providing banking solutions, maybe having bank accounts for these businesses, or credit. We'll talk about that in a second, because that's actually part of the reason why their stock's down. Then they're offering software solutions based on very specific verticals. They recently completed the merger with Lynx. And so overall, yeah, they started off with this merchant acquiring business, but through several acquisitions and organic investments, they've effectively expanded their addressable market from 20 billion real to 120 billion. So you're looking at a 6x increase in what's potential for StoneCo. And as they talk about, Stone is evolving to become a one-stop shop for commerce in Brazil. This is big development, looking at all these different things. And as you look at across the board, they're just growing in each of these things, whether or not it's banking with accounts opening, hyper growth, credit solutions, still, significant growth from if you zoom out over the last few years or quarters. And then software with their Lynx acquisition, fantastic growth. Their acquiring business is still growing very quickly. So tapping into a huge market, and they have a 3% share. So this is real potential over time. So why is it down? So I would say there are a couple of different things. One is, let's just start high level, which is that operating in Brazil is really, really tough. I mean, one could just look at it on the currency perspective, where relative to, let's say, the US dollar, it depreciated by 15% in 2018, another 4% in 2019, then another 22% in 2020. It's really tough to maintain a strong investment in US dollars when your operations are in Brazilian real and you're facing this type of headwind year after year. Now, why are they facing this headwind? Once again, this points to a super tough environment to be operating in, because they just, this gets to a model that's just not working as well. You're looking at high unemployment, very, very high unemployment. You're talking about low teens unemployment rate, combined with, depending on how you measure it, significant inflation rates. So this is just brutal economic data points that you see here. And you also see the the socio-political, aspect of being significant risk area, where there's talks about, the current president, potentially considering a coup and attacking the Supreme Court. So there's a lot of challenges with Brazil currently right now. So you're looking at, I'd say, negative sentiment combined with very real risks as you look at Brazil. But then I'd also argue that execution is a key element where their revenue was down 8% year over year, and their profit, adjusted income, net income, swung from a profit to a loss from the second quarter of 2020 to the second quarter of 2021. So if you're a hyper growth investor or a quant investor, let the computer algorithms, do their thing, and they see, oh, growth, 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 and now a negative number, that alone is cause to sell off the stock, just because you have a computer algorithm that says, hey, we're judging whether or not this is top line growth. So to show a negative figure makes you wonder, oh, okay, well, what's going on here? We want to understand. Let's dive deeper to actually understand. And as you actually start peeling it back a little bit, you start saying, well, wait a second. There's actually still a lot of growth going on here where their core merchant acquirer business is still growing very fast. They talk about net revenue from transaction activities and other services. That's really their merchant acquirers. As more transactions go across their platform, you're talking about 60% revenue growth there. They talk about their subscription services and equipment rental, 90% growth. Other financial income, you're starting to talk about, like their software solutions up nearly 90%. 60%, 90%, 90%, that is fantastic growth rate. So why is their revenue down 8%? Well, because their financial income dropped nearly 90%. That is huge. And so we need to dive into that to understand what's going on. Like, is this a potential blow up risk, in terms of financial income? One should always, try to understand this aspect. And so from a financial income perspective, they focused on collateralized credit backed by credit card receivables. So effectively, if a merchant, has a typical business in Brazil, they do have more installment type payments. But if you have a customer come pay with a credit card and they're expected to pay that off over, let's say, a month or two, what they'll say is, hey, if you need those funds now, we can effectively provide factoring. Effectively say, hey, you can get it, but you'll only get 90 cents for every dollar, or 90 cents for every real, the equivalent of. And so that's the challenge, or that's the opportunity that they have. They view that as generally better risk reward than higher risk loans. And you can think of all sorts of, non-collateralized products. And so this is a secured product. However, they have faced significant problems recently because of a new regulatory framework that was launched in June, 2021, that was regarding how to accurately register the different receivables. And that I can make a whole separate other video on this because the topic is fairly complex, but it ended up resulting in higher delinquencies than what they expected. And so what they're looking at is considerably worse recoveries from non-performing clients, considerably worse collections on effectively their finance portfolio where they're lending out, funds against a credit card receivable. And so you'd think this would be a lot better. So they say the reason why this happened is, one, you do have the COVID pandemic. So that is part of it. But the bigger two reasons is because of this new framework where they had this, effectively the framework that this new regulatory framework that was rolled out was completely dysfunctional. They talked about the ineffectiveness of the card collateral system, not being able to appropriately say, okay, well, wait a second, is the collateral actually there? And then this was further reinforced and weakened by the inappropriate behavior of some merchants who effectively took advantage of the system. And so they quickly, stopped credit disbursements, as they recognized, wait a second, there's something wrong here. So in June, they said, okay, we're cutting this significantly. So you see in July, they effectively cut it to zero. But they said, oh, okay, we also need to say, you know what, given this environment, we also need to make sure we set aside the correct amount for these non-performing loans, these loans that are, let's say, past 60 days due. And so, but based on what they've done in the second quarter, they're saying the coverage ratio for non-performing loans is 112%. So you shouldn't have really big blow-up problems in the future, especially given that their credit disbursements have gone to close to zero recently. They view this likely as a one-time problem, largely in response to this new regulatory framework. I can make a whole separate other video about that just because it's such a complex subject. But for this video, let's just keep it as this to understand, like, okay, there was a one-time problem. You also overlay that with a more complex COVID environment, and they're likely addressing it now, trying to be upfront, trying to prudently address the problem. So what are my thoughts on the valuation? Here it is. I'm going to do a quick plug where if this is your first time tuning in, please make a point of hitting that subscribe button, hit that thumbs up button. If you want to follow my personal journey, what do I buy, what do I sell, go to unrivaledinvesting.com. Click on Journey. First week of the month, I call it my full portfolio. By the end of the month, I call it a potential multi-bagger. And on a daily basis, I'm interacting with the Unrivaled Nation on our exclusive Discord server. So check that out at unrivaledinvesting.com. And so as I look at StoneCo, STNE, I'm effectively penciling out nearly 200% upside and nearly 50% downside over the next 5 years. And that's how I'm thinking about it. You can look at sort of the assumptions that I'm laying out here. The really interesting part about this is that their growth rate has decelerated so significantly in just the last few years, from 100% plus to 63% to less than 30% last year. This year, not sure what it's going to shake out to be. The third quarter, it was down slightly. Year to date, it's up, nearly 20%. So I'm looking at this and I'm sort of saying, well, maybe it's 5 to 15% growth this for on a combined period for this year. It's tough to say. That said, they have historically been quite profitable, of 30 to 40% operating margin. So that's what I'm assuming here. And then, what's sort of the growth rate that you want to assume in the years ahead? You can have your own assumptions. If you sort of have a different take on what you think their growth prospects can be in the years ahead, I'd definitely love to hear it. And so, end multiple 5 years out, I'm assuming 20 to 40 times. And so that's what's really getting this sort of upside of, let's say, 200% and downside of about 50% over the next 5 years. Despite the recent stock decline, I'd argue it really depends on their ability to reaccelerate their growth rate from here, because clearly their growth rate this year is coming down quite a bit because of the sort of the hits to their financial income. You also have COVID impact last year. So the question is, can they reaccelerate it back to 50% plus in the years ahead? If you can, there's a good chance this could be a home run stock. And one, I'd argue they're doing a lot of things, tackling a lot of different verticals, banking, credit, software, as well as merchant acquiring, where they're doing very well. And I called out why they're potentially unrivaled earlier. So they're doing a lot here. And so there's that potential. But if they're not able to execute, then I'd argue, you are sort of stuck in the doldrums in terms of a potential investment return. The other complex aspect is, like, you have to make a call on, macro, on politics in Brazil, how you think that'll play out, what do you think will happen with the currency. So there's a lot of aspects to this to consider. As I've already mentioned, I personally haven't pulled the trigger yet for myself. If I change my mind, I will call it out to my Unrivaled Investing Journey subscribers, the Unrivaled Nation. I'll also set up an exclusive Discord channel to talk about it, because there are some risks. You have to go to the SEC filings to see all the risks, but there are some risks and sort of uncertainties that I'd also call out as well in that channel to talk further about it if I ultimately do pull the trigger. That said, what I have pulled the trigger on is my most recent potential multi-bagger that I called out to Journey subscribers in August, where it's a company growing even faster, much faster than what you're looking at with StoneCo, trades at I'd argue, a much cheaper multiple. So growing 200 to 300% and trades at like 4 times sales is profitable. So for that, you'd have to go to unrivaledinvesting.com. If this video has been helpful for you to learn about StoneCo, STNE is the ticker, learning about their potential in Brazil, everything that they're offering. If this has been helpful for you, please make a point of hitting that subscribe button, hit that thumbs up. Thanks so much for watching.